I lead this company called 8X Ventures. We are a deep tech venture capital firm. And when I say deep tech basically means different things for different people. But as long as it is not something that can be replicated in a month by someone else, in terms of the product itself, we call it a deep tech. So the product ideally should have some intellectual property or some novelty in that you have built. So that's how we qualify as deep tech. But the same, but even if your definitions are different, the discussion we're going to have today is going to apply to most of the people. The topic we wanted to talk about was the inside the brain of a deep tech VC. And when we started having this conversation with IIT Chennai, the incubation team, the realization was that even though a lot of you have either already interacted with the VCs or will be interacting sometime soon, understanding how exactly they are reviewing you might be able to help you understand. And there are a lot of frameworks which are available online as well. If you Google it, you will find a lot of frameworks available online. The trouble that I feel a lot of startups have is that it's the information overload. There's too much information available online about how they are evaluating, which may or may not come from the VCs. So I thought I'll focus on the part that what happens when we receive the pitch deck. We all good so far? Any thoughts, any questions? Is this in line with what you were expecting? So I'll start the conversation with that identifying winners in the deep tech requires a slightly nuanced approach versus sector agnostic VC investing. And the reason I'm starting with this comment or thought is because a lot of VCs out there in India, there are about 300 plus VCs right now in India. But in reality, most of them are sector agnostic. And because they are sector agnostic, the approach that sector agnostic VCs take is different from how a deep tech investor takes. And there is a nuancing difference. And because there is a nuancing difference on how they will evaluate, you need to probably talk to them in slightly differently in a slightly nuanced way on are they a deep tech VC or they are a sector agnostic VC. Unfortunate reality is the sector agnostic VCs are a bit more cautious of deep tech because in India in particular, consumer tech, edtech, and fintech were taking precedence for last couple of years. It's only recently that the trends are starting to change towards deep tech and frontier technology now. So now we scouted through the different websites, scouted through articles, and we have categorized all possible approaches that are used by different deep tech VCs in 3 clusters. On how do they identify winning deep tech startups? There are 3 approaches. First is based on the maturity. Second is based on sustainable competitive advantage. And third is based on investment readiness. So all the firms are using either one of those 3 approaches or a combination of them. Even if you go to angel investing, even if you go to sector agnostic, even if you go to deep tech, they all are using one of the 3 approaches now. And that's the most prominent 3 approaches. Of course, when you do a combination of that, it might be some nuancing that needs to be mindful of. But that's the approaches that exist right now. What I'm going to do now, I'm going to go in each one of them, 1, 2, and 3, and talk about what's inside number 1, what's inside number 2, and what's inside number 3. Maybe if I can hear from you, Ashok, on is this in line with what you were expecting? Or
yeah, definitely. It's like we have a startup, so we are just trying to get the VCs onboarded. But yeah, we are just finding the ways. So definitely, it will help us in some sense. Yeah.
Got it. Thank you.
Because like lots of investors to have like aligned to a certain type of industry, I would say. So they thought in that perspective, but it may not be possible always that what you are trying to do is aligned with their category. So it's
Right.
like how you can tweak those things out there, or how you can find the other pieces which are more aligned. So how to understand the whole architecture there. So definitely I'm saying that like the topics are kind of, we love that.
But what you said is very interesting. So when the VCs are aligned with a particular industry, and you are not in that industry, then definitely not happening. Then none of these frameworks or knowledge of these frameworks is going to help.
Okay.
But these frameworks are going to help only when you are talking about the industry that is in line where VC invests.
Can we have like something like, even though like the investor are aligned with a certain type of industry, can we make them like, okay, how this gonna help you in some way? And then like everybody is gonna make the money. So how we can convince them to just invest to us so that they can also get some?
I'll give you a short answer and I'll give you a long answer. The short answer is no.
Okay.
And the long answer is because how VCs operate, like even how we operate, we have told our investors we are a early stage deep tech VC.
Right.
Now, if we do anything beyond that, I have to go back to my investors and inform them, which are typically institutions or family, high net worth families or high net worth individuals. And then I have to inform and take their approval that what I'm doing now is different from what we wanted to do. So because I don't want to, and most of the people that you will meet, they don't want to go through the pressure of going back to the investors and saying, oh, by the way, we want to change where we are going to make an investment. That's because of those reasons you cannot change. If they're not in line with the industry, whatever you say, more likely than not, they cannot change. The only exception is that if you're talking to the managing partners of that VC firm, because more often than not, the first call that you will have will be with an associate or with a principal or a VP in that fund. And they do not have the authority to make an exception. Right. The partners, not always, but very often have the authority to make an exception if they believe that actually you are amazing. So they can make about 10% exception, depending on what's the mandate. 10 to 15% exception is acceptable, but they need to have a very strong reason as well. So generally, the people who are the mid to junior level, they cannot make an exception, but the managing partners can make an exception.
Right. Sorry. So do you think like angel investor does that? Like they are not like, they don't have those barriers like to connecting with the other people. So do you think like, even though like they are at the end, they are also aligned to some particular field? That's what I say.
So angel investor is a completely different beast, because angel investors, especially the angel networks, more often than not, and I personally, I'm never in the favor of angel networks. Almost like if you ask me, should I take money from angel network? My default answer is try not to.
Okay.
Because more often than not, angel investors have very limited insights or understanding of what's happening in the market dynamics, or even the technology. They don't even have the time and patience. A lot of people who are angel investors and are putting money, they have very limited understanding of the technology. They have very limited understanding of the market. For them, it's you can sell things. You can actually make them invest in your startup, but it's just cash. It's just cash. It's basically and half the time what they have understood what you do is different from the realities of life.
Right.
So angel investor is a very different beast.
So
Abha, I can see you have a question. Go for it.
Yeah, Abha.
Hi, thank you. I have a follow-up question to what you were just mentioning right now. How is it different, whether it is from an angel investors, a network of angel investor, or a network of a VC, or an individual, let's say an individual VC or an individual angel investor? How it is different, and like what are the pros and cons of both?
So I'll first take the first part of the question on how is it different. How is it different is VCs generally will not take spontaneous decision. They will spend a lot of time doing a research, and that when I say a lot of time, it means months and sometimes even quarters of tracking you, doing a research with you on you, and coming up with a holistic perspective on the startup, and then making a recommendation that do we want to invest or do we do not want to invest. And like, I'll go into the details, but like the three frameworks that I have on the screen right now: maturity of the startup, sustainable competitive advantage, investment readiness. VCs will spend a lot of time going through each one of these frameworks before they make an investment decision. However, more often than not, the angel network investment often, or not always, works based on, oh, I have heard that the AI companies are amazing and we should invest in AI company. Oh, I heard this AI company, Chennai Angels was presenting this AI company. Let's put some money into that. One of my friend made like 30x return in an AI company. I want to replicate that. Or my cousin told me to invest in this startup because it's great potential. There's no other technology like this, and there might be thousands of other companies like that doing the same thing, but they do not have the time, resources, or the mental bandwidth to conduct detailed research on the startup before they make the investment. So angel networks are more of a salesy. If you are more salesy and you are a very smooth talker, you can actually get money from angel investor. VCs, of course, you can, if you're a smooth talker, it helps, but they will do a lot of research, and just being a smooth talking is not going to get you through, more often than not. Does that answer your question, Abha?
Yeah, to a certain extent, yes. Thank you.
Any other question before I move on?
What stage do you suggest like talking to a VC? Like,
at what stage I suggest talking to a VC? So is this question from Life is Craft, right?
no, Arvind.
Arpit, okay. Arpit, unfortunately, I would say you should be talking to VCs all the time, because they are VCs for different sectors, different stage of maturity. They are VCs from pre-seed to all the way to Series C, Series D, Series E. The market landscape is huge for the VCs. So you should be talking to the VCs. And sometimes talking to VCs is also a good reality check that you might be thinking great about yourself. And the moment you go there, you'll get punched by VCs very hard. And you'll realize, oh shit, this is, I didn't even think about these things. So sometimes it's, I would say, whenever you have time or whenever you can make time, you should be talking to the VCs. But if I'll also add to this, if you're thinking of fundraising, you should also always have a visibility of 9 months to a year. So if you want to do fundraising, let's say in about 9 months, you should start talking now, because the first 3 months will be a learning journey on how VCs operate. And that after 3 months, you'll start getting some real traction from the VCs. So it takes about 3 months at least. Most VCs, not all of them, most VCs will listen to you in the first call, but they will hibernate you. They will keep tracking you over a period of time. And then it takes about at least 3 to 6 months to close the conversation with the VCs. So you should always be talking, but you should start talking seriously about 9 months prior to the date of you running out of cash. Does it answer your question, Arpit?
Yeah, thanks.
Maybe I'll take one last question, then I move on. Okay, so now coming back to this slide that I have on the screen, there are 3 different approaches how VCs used to identify which one is a winning deep tech startup. And I'm using the word in double quotes, winning deep tech startups, primarily because I know we all are humans, but for VCs, at the end of the day, it's numbers in an Excel file, all the startups. With all love, I'm genuinely in love with the startups where I've invested my personal money as well, or the company's money. But I know I put it in quotes because at the end of the day, the love starts to fizzle out if they don't generate 10x returns. So that's why winning deep tech startups has 3 different frameworks: maturity, sustainable competitive advantage, investment readiness. I am now going to go into the number one on how do VCs assess the maturity of the startups. So now VCs look at the maturity of the startups on two axes: technical maturity and the market readiness. And we have tried to find common grounds with how different players are doing, but a lot of them are using different variation of this thing. Technical maturity is how mature you are in terms of technology. Are you at the early stage or are you at the late stage of the technology development? Do you already have some intellectual property in place, or are you applying for the intellectual property? Have you already received some patents in place? Where do you stand in your technical maturity? That is the x-axis. Y-axis is how ready is the market to accept this new technology or the new product that we're talking about. And when I say a low market readiness, that means that even if you prepare the product, the market may not be ready to accept that. There were people who launched EV vehicles or EV cars in 1989 also, but the market was not ready at that time. But now the market is ready. So this XY axis, no startups, or it's not a static. So where you are on a technical maturity or where your market is not static. It will keep evolving. If you ask me from air to meat or different technologies, it was not market ready, but now it's getting into more market readiness. So that every startup moves on this XY axis constantly. The numbers that you see here in percentage indicates how many percentage of startups, according to BCG, typically fall into that buckets. So development bets are about 45%, potential quick wins is 15%, technology bets is 30%, and demand bets is 10%. Now, let me talk about each one of these boxes very quickly. What is a development bet? Development bet means that you see that the market is ready. Market is ready to accept a lot of solar equipments, a lot of renewable energy. Market is ready to do that. But are we technically fully ready to use solar? Maybe not, because there's so much innovation that is still pending or is in the process for solar innovation right now, for example. So those are the development bets. Now coming to technology bets. Technology bets is that you are yet to build the market and you're yet to build the technology also, but you believe in a few years, and this is where probably SpaceX might fit in here, that they are building a technology to go to the Mars, and they want people to start using technology to go to the Mars. Is the market ready? No. Are they technically ready? No. But they're pumping in a lot of money around that. So that's a technology bet. Then there are demand bets. Demand bets are there where you are building the technology, but you are confident in a matter of time or maybe a few years, the market will become ready. Maybe the market did not even know that actually they need it. Once you build it and serve it on the platter, you might uncover that the market was ready. Airbnb, Uber fall into that category. They were demand bets. They built the product, and at that time no one was asking for it. When if you talk about biotech or the medtech solutions, there are some amazing medtech solutions available in IIT Chennai incubation. There are amazing biotech solutions available. There are amazing agri-tech solutions available in the incubation center right now. But is the market ready for them? No. Do I want to do if I want to do a surgery, do I want a physical doctor or a robot to do it? Probably a physical doctor. So even though the robots are available, even though you can have the best of the doctors remotely standing there and conducting your surgery, which will be more accurate, I would prefer not a robot, but probably a human standing and doing a surgery for me. So those are demand bets. And potential quick wins is where you have built the technology and the market is ready now, and you're ready to make the impact. When you go to the VC, it's very important to understand where does this VC put the money. Do they typically do technology bets? Do they do development bets? Do they do demand bets? Or do they do potential quick wins? There are different VC for different buckets over here. And unless you understand that where do they typically invest, even the best of the pitches will not get through. You might end up speaking with 50 VCs in development bets, but you are actually in the category of demand bet. So it's a waste of your time, waste of their time. They're not going to respond. You're just going to feel disappointed. So that's the way VCs categorize the maturity of the startups. I'm going to pause on this one before I go to the second framework, just to take some reactions or questions on this. I can see that there are some people who join later on. Any questions on that? Sorry, Vijay, you saying something?
Yeah, hi, sir. Hi. Hi, Chirag. So this is Vijay C.B. Chakravarti from Future Contact. Yeah, hi. So thanks for this. And I have a doubt. So is there any way to identify the bets the VCs are in? So how to identify what bet is a VC into?
So more often than not, I recommend that you go to the VC website and see their portfolio companies. And of course, it's a time-consuming process to go through their portfolio companies. But when you go through the portfolio companies, you get a sense that what is a typical pattern that you see. If you see a pattern of technology bets, don't go and pitch for potential quick wins, because the likelihood is that they will not invest it. So even if I talk about Sequoia Capital, for example, which is one of the biggest VCs in India right now, or talk about Tiger Global. So Sequoia actually invests a lot in right now in the potential quick wins, or they go into the demand bets. Tiger Global, the proportion of demand bets tends to be higher, and they also do development bets. But that's based on my analysis of when I read their portfolio companies. You should, when you read their portfolio companies and when you go to them, you should categorize in your mind that where are they putting most of their time, effort, and portfolios in right now. And based on that, when you start the conversation, I'm not saying change your company from your description of demand bet to a technology bet, for example, but you might want to nuance it and help them understand that I know that this is where you typically invest, and I know this is where I am. Do you think you would want to talk further on this or not? Does it answer your question?
Yes, yes. Thank you. Thank you.
Hi, Chirag here.
Yeah.
Yeah. So I have this doubt in development bets. Do the VC look at the product market fit there? Because if the technical time, the approach to technology is wrong, then the product market fit may not be possible by then. Because till now, every investor will look, with my experience in all these lectures, they look at product market fit as a basic thing, which we have not covered. And in this development bets also, it is not covered. So do they either look at it, or it is common to all the bets?
So it's common to all the bets. The product market fit is common to all the bets. And if I may add, actually the product market fit is I feel, this is my personal view, is an overused term by VCs. Because even if you talk about Zomato, for example, even if you talk about Ola, for example, they are still evolving with their product market fit. It will keep evolving, the product market fit. You need to have the conviction that can you achieve the product market fit on the go or not. And it will keep changing. Your customer base, their behavior, everything will keep changing as you go along. So it will be, so yes, to answer your question, VCs look at product market fit in all the quadrants on this framework. And B, I would not take it as a deterrent that if the product market fit is not there, that does not mean we cannot get to the product market fit. Paytm still has not figured out the product market fit. They have figured out the customer product fit. They have figured out a product market fit, but not at the price point that which they want it to be. So it's a very evolving question, the product market fit. I'm not sure if I'm really answering your question, Pragyan.
Yeah, I got it. But see, there's another way of looking at it. Suppose you are still developing it and you don't have revenues, and you yet to have get a pilot. In that case, is like you said, we should not approach angel investors. Then who is the alternative for us? If VC is not the alternatives.
No, you can. So there are VCs in each of these quadrants. So there are VCs doing technology bets. There are VCs doing development bets. There are VCs doing demand bets. So there are VCs in each of the quadrants.
Correct. What I'm trying to say is, in development bets, the technology development time is longer, and you need a lot of cash to develop the technology to even to go to a pilot stage.
Yes.
But then will the VC in development bets still fund that company? On what basis they'll fund?
On the basis of the team, typically. Does the team have the capability to? So there is a very interesting case on this. Give me just 1 second. Let me switch on the air conditioning. These are a very interesting case study on your question, Pragyan. So if you look at Adam Newman, who was the founder of WeWork, his latest venture. So the market is ready for short-term leases. And right now he has no product in the market. And A16Z gave him like some $150 or $200 million just based on the idea and based on the person. So yes, it's a development bet for A16Z that he will be able to build a solution or technology solution for the market, which is already ready for the short-term leases in the US. There are VCs ready to do that, and there are VCs ready to wait, except that the team has to be very solid. I'll move on to the next slide, unless there is a question. Okay. Background coming from someone. So unless there's a question, can I request people to put yourself on mute, please? Yeah. So that is the first framework. And as I said, different people use different combination of framework. Now, this is a second framework, identifying the sustainable competitive advantage of the startup. Of course, different people have different meanings for a sustainable competitive advantage. There are three common things that we found out that almost every VC is asking these days. Not everyone is asking all the questions, or at least a large portion are going to ask you one of the three, or two of the three, or three of the three questions. The first is, does the startup integrate multiple technologies? Because when you use multiple technologies, your likelihood of being replicated goes down. Because someone may be able to replicate one technology, but when you are using multiple technologies and integrating them, it's a little bit more complicated to replicate. So that kind of builds some walls around your startup. Second is the startup embedded in the deep tech ecosystem, i.e. universities, research lab, government, corporate R&D, etc. If you're standalone sitting in Patna and doing building an amazing product, the likelihood of getting funded goes down. You must have relationship with the ecosystem. You must be present in the ecosystem. And the third is, does the startup solve a fundamental problem? Is it transforming an industry or not? And sometimes, is it even making an impact on the UN SDG goals or not? So I'll give you some very specific answers to each one of them, or some statistics for each one of them. So on the first one, does the startup integrate multiple technologies? 96% of deep tech ventures that get funded use at least 2 technologies, and 66% use more than one advanced technology. About 70% own patents in their technologies. So when I say deep tech ventures, I'm talking about the funded ventures. So you will notice actually the VCs are more likely to fund startups that are integrating multiple technologies, or are using advanced technology, or there's some patents in place. I am not saying that having patents will guarantee to get the funding, but if you are a deep tech, the likelihood shoots up when you have some patents in place. On the question number B, is the startup embedded in the deep tech ecosystem? Right now, there are about 1,500 universities, research labs. There's so many grants that are available right now in India for deep tech ventures. So, and I put in a link here. I'm going to copy and paste it as well into the chat. That link has list to all the grants that are available in India right now. So I've copied and pasted this link in the chat. But there are like 1,500 grants available, and sometimes getting a grant is also a validation that you are part of the ecosystem. Now the question number 3 is, does the startup solve a fundamental problem? 97% of the deep tech ventures that get funded contribute at least to one UN SDG goals. I'm not saying that you need to force yourself to solve UN SDG goals, but more often than not, if you're a deep tech venture and you are actually fundamentally changing a problem or solving a problem, you will make an impact on the UN SDG goals. And I'll show you one XY matrix again. I'm still on the framework 2 on the UN SDG goal. So on the x-axis is the impact that you're making, and the y-axis is the financial return that you're making. A lot of impact investors or impact VCs also review the startup across these two axes. So x-axis is, are you making a zero impact to the SDG goals, passive impact, intentional impact, or evidence-based impact? And the y-axis is, how much financial return are we expecting? Is it a complete loss of capital, partial capital recovery, below market rate, or the market rate? When you go to the impact investors or an impact VC, they are focusing on the dotted box that I have. The dotted box actually indicates which is where impact. If you go to the impact VC and tell them that you are going to make a less than market return, or the capital may or may not come back, or it's a complete loss of capital, even if you are solving world's problem or the entire climate change problem of the world, it's very unlikely that you will get funded. So when you are talking to impact investors, or even if you're talking to other VCs that look at the impact investing as well, you need to highlight that A, what is the impact that you're making? Is it passive, intentional, or evidence-based? And B, you need to talk about that even though we are making an impact to the world, that does not mean we will not generate returns to you as an investor. We will make sure we will generate as good returns as any other startup. So that is coming back to the framework of 1, 2, and 3. So we talked about identifying the maturity of the startup. We talked about identifying sustainable competitive advantage of the startup. I'll move to identifying the investment readiness of the startup, and then I'll pause again. So now, how do VCs look at the investment readiness of the startup? So this is a framework that I brought down from the fundamentals of entrepreneurial finance, which is taught in the Oxford University right now. So in the Oxford University for the venture capital course, or even in the Cambridge and quite a few universities, this is the venture evaluation matrix which is taught. And in real life as well, every time there is a deal that is happening or a startup investment that is happening, the VC partner will ask all of these questions or a combination of these questions to the analyst or the associate or the principal who's involved in the startup conversation. And if that point of contact that you have does not have answer to these questions, then the partner's interest go down. So it's also, of course, they need to ask those questions, but you also need to make sure that you provide them this information so that they can answer these questions to their partners to help them make the investment decision. And it can be in different formats, whichever format that is comfortable to you. So if you look at the rightmost column, there are too many questions. I'll not go question by question. If you look at the rightmost column, which is attractiveness, the value proposition for the value proposition across 3 columns, customer, company, and entrepreneur collectively tells about does the venture create value to the customer or not. Similarly, in the industry column, all customer, company, and entrepreneur questions collectively give the answer: is the venture in a large or growing market or not? And similarly for the strategy, can the venture capture value by conquering and retaining the market share or not? And these answers are basically a combination of all the sub questions that you're looking at. The questions on the right, the attractiveness section, are the ones which are most often, almost every startup conversation is discussed, and the person who's discussing with the startup from the team, let's say an associate in the firm, in the VC firm, has to defend the answer to these questions with substantial data points. So we've talked about 3 approaches and that different VCs use. And as I said, everyone uses a combination of these. I'm going to pause here and look for questions. It's very quiet. I was expecting there'll be a lot of questions on this slide.
Hi, Chirag. This is Balaji from Solid Pro Engineering Support.
Hi, Balaji.
Yeah. With respect to the team, the first question is, do the founders have the required skills and experience? Right. Currently, we are working on a DeepTech product, which will be catering into the industry sector as well as the HVAC sector. Basically, we are building an energy efficient motor, okay, with the help of AI and ML technologies. But when coming to the founders' skill and experience, we directly don't have that deep tech skill. But we have brought in a person who has done from PhD from IIT, who proposed this idea. So how do then we fit into that column?
Does this person have equity in the company?
Yeah, we have given 5% of equity to him. That is the proposal.
So if you have given him 5%, he is a co-founder then.
Okay.
Theoretically speaking, anyone with more than 5% equity in the company is a co-founder in the company. So, so you do meet the requirements. I would have actually liked to see the person with the most relevant skill to at least have 15% equity in the company, but 5% is at least good enough to start a conversation.
Okay, sir. Thank you.
And Balaji, if I may add, the reason this question is asked, that do the founders have the required skills? Because increasingly, especially for the deep tech space where you are, getting the people with the right skill set to hire and to retain them for a long term is very difficult. And when they leave, actually, if the people who are holding the technology pillar for the company and they leave, replacing them is almost impossible. So that's the reason the founders with the required skills must have a substantial equity.
Okay, got it. Thank you, Chirag.
Thank you, Balaji. Any other question on this?
Chirag, Pragyan here. What is the size of the market the VC generally look at? How do you know it is a small market, a big market? For me, it may be a big market. For the VC, it may be a small market size.
Yeah, are you referring to the question on how large is the target? Or okay, this one. So when I say how large is the target market, when I will ask this question internally, I will typically ask for will hope to get a specific dollar answer. Like, are we talking about, if assuming Pragyan is running a startup A and he captures 100% of the market moving forward, even what is the size of the market? Are we talking about a market which is like a $10 million market, or are we talking about a market which is like a $1 billion market? And more often than not, the answer, whatever answer we'll get, will be directional and not accurate. Because sometimes when you build the product and the life changes, things change, economy changes, it'll change. But if you are, just to give you a directional answer, if you are at a early stage, when I say early, I mean seed to Series A stage startup, any market which is, if your target market is less than $50 million, generally the VCs will lose interest. That even if you capture the entire market, the maximum you can get is $50 million. It's a relatively small size. But having said that, a lot of businesses never existed before. So sometimes it's very difficult to even make a projection that how, sometimes I have done that, and I find it very interesting. I will have conversation with the startup that what are the different scenarios on how the market will look like in 2025, for example. And scenario A, very optimistic scenario, scenario B, very pessimistic scenario. And when I say optimistic, pessimistic, not just in terms of how we will be, also how competitors will be, also how market or the customers will be. So collectively, we will create like some XY matrix or a combination of that to have sensitivity around that the lowest expectation of the market size is maybe like $40 million. But if these things change, the market might be $1 billion. So yeah, it's a tricky question. Does that answer your question, Pragyan?
Yes, thank you.
Cool. I'll move on. So we talked about these three approaches that are used in the across different VCs. These are the slides that I had. So I'm going to stop sharing now, and then we can have a conversation about anything or any experiences that you have had about DeepTech VCs, and I'll be happy to answer those questions to see how has been your experience, what went right, what did not go right. Would love to hear that. So how has been your experience talking to the DeepTech VCs? What kind of questions they were asking? Did these frameworks make sense to you now, or do they not make sense to you now?
Yes, some make sense. I think the last slide which you showed gives a very good perspective in a very summarized manner. And a few things which I faced was when you start interacting with a VC or a seed investor also, you give them a projection, correct? And they expect a projection of 5 years. And when actually the investment comes is after 9 months or maybe a year or so. And they'll ask you that, okay, 9 months has gone, what have you done according to the projections you have based? This question is not, I don't think this question should be asked by the investor because they have not funded it. And they are asking that what they don't, because the projection was made considering the funds comes at day 0. But it has been 9 months now and they have not given any funds. But they are asking this question, what have you done till now? How is it going according to the projections? So this is a very critical question for them, but we don't have any answers for them. If you are at those revenues numbers, it is good. If you don't have, then you may lose the investment there itself.
No, I completely understand. I completely sympathize with you also, because to be honest, sometimes I also ask this question that it's been 6 months we have been talking, and what has moved, and where do you stand now? So I know it's a tricky question, but I'll tell you some of the startups what they have told me, which has stayed in my mind, and that has been very useful. So one of the startup, what they did was they kind of like in the discussion, they created a kind of baseline that this is how the baseline we will perform moving forward in the next 6 months to a year. And like it was already in their data room. This is a baseline projection that we have, assuming we'll continue to be bootstrapped, or because they were bootstrapped at that stage. And then they had a second line which was showing that how they will progress given the funding of $1 million. And this is the plan, incremental plan that they have. And then they had a third line, which was like a very optimistic scenario that if they get like a $5 million funding, how will that line look like and where will the money be utilized? So it also gave me a very clear view of that these guys have a very strong view of how to prioritize the money. And they were kind of able to avoid those questions, at least from me, that 6 months later, that it's been 6 months and we have been talking and what has moved. And me saying, they're saying that, oh, actually not much because we were waiting for the money to come in. And honestly, when people say that we were just waiting for the money to come in, it's I can imagine it's a lot of piss off to a lot of investors that you're telling me that if I don't give you money, you will stop moving, because you are an entrepreneur. You're supposed to take risks. You're supposed to take chances, and you have to keep running faster than everyone else. But I know, like, you can't be taking fixed costs. So we, even though most of the VCs know that this question is going to be a sharp edge, but we still have to ask that question. Because that's kind of our due diligence to make sure that you guys are running as fast as possible. I'll move on to Arvind.
Yeah, we got just incubated in Nirman, and like we have not started talking. But just yesterday I met a VC, but the intention was not for fundraising, just to talk about the market. And just saying the idea itself got him excited, and he gave him this like card, and like, he said like we have to keep in touch. And like, I said like we are still, we have to still develop the team and like searching for team building. So I feel like I think the team part needs to be filled as something that then I think it would be a better position. This is actually in space tech, so the team plays a major.
It's going to be very interesting actually, because in the space tech space, as you rightly said, the team is a very critical part. So generally, Arvind, I'll give you some unsolicited thoughts on this. Generally, when I meet the VCs or startups, or when I was a startup and I used to meet the VCs, I always used to ask, what's the investment process that you follow? And because a lot of times people say that they're excited, and I'm sure they're excited about what you're doing, and I'm sure you're doing something great. But I would want to go one level deeper to understand what is making you excited. And the reason I will ask that question, and I would suggest you ask that question on what's making you excited about us, because then you can double down on that next time you talk to them, because then it'll be easier conversation for you guys. So that might be useful. I don't know if you have already thought through this.
Okay, because based on what I understood is like he has already invested in similar companies that are in the US that are solving similar problems. So that is why I thought he was interested in this one.
Amazing. Now let me give you a counter thought also, again on unsolicited. When people say that I've invested in a similar company, I would suggest you should ask the question, would you want, does your investment thesis allows you to invest in companies with similar technologies, or do you have restrictions around that? Because in some VCs, there are strong restrictions around that. But that's just unsolicited thoughts. I'm sure you had a great experience around that.
Yeah.
Balaji, moving on to you.
Yeah, it was an amazing experience with this session, Chirag. You gave a lot of insights. When coming back to one more question with respect to the company structuring, first I will let you know about what we are doing. We are, as I already informed, we are developing a product, a motor, which is using the DeepTech technologies, and which will cater to the industrial sector as well as the building sectors. So we are an incubator of Crescent Innovation Council, and recently we pitched for the Startup India Seed Fund Scheme, and so now our product is into the, we have developed the product and it is into the testing stage. This is with respect to the product development. Now my doubt is on the company structuring, because we are currently, it is being bootstrapped, and we are funding this project from our company. We have a regular stream of income. Say, for example, our engineering support, we are doing engineering services to global clients. So we have a regular stream of income. And we want this to be a separate spin out from this, because we don't want to open our books because it is already making $1 million from our engineering services. We don't want to put everything into one basket. We want to have a separate spin out. So what we thought is we will form a company like holdings or investment kind of company, wherein myself and my co-founders will be there. That company will invest into, it will have stake into this newly spin-out company. Will that be okay for any VC to come in when they want to invest? Because already we are also an investing company. Means it is framed in such a way. Will that be okay for any VC company?
So the answer is yes, it will be okay for the VC companies to do that. However, you might want to talk to a CS, a company secretary, because the bigger question that the VCs will ask you, you are in a deep tech space or on a space where some of the VCs might want you to move to the US or the company's legal structure to the US. If you do that structure, you might want to ask your CS that can I in future move that to the US or not? And if yes, how will that work? Having that understanding is very important, because some of the VCs that invest in the technology that you are talking about, they want to see that can you move the company to the US eventually or not? Because some VCs with the larger checks do not invest in India.
So in that case, then I have one more question, Chirag. We do have a sales office in US actually, because our clients in US, they want us to have an office in US which needs to provide the professional liability and commercial general insurances. So we do have a sales office in US. Whether this idea can be patented in that name, because we do not know that if suppose we take this idea to the US company, it will be applicable for the Indian funding or to the incubation in India, because that doesn't fit into the Startup India framework, right?
Yeah, exactly. So you need to prepare the legal structure that you need to prepare is for India right now, because you are an Indian company.
Yeah.
But for a big market for this is the European and the US market, and maybe the Middle Eastern market as well. So from that perspective, even though you're preparing the corporate structure for India, you should prepare for India. You should ask that question to your CS, your company secretary. If I were to move this company to the US or flip this to the US, what is the process and what are the implications of the structure that we are talking about on the flipping? Because certain structure cannot be easily flipped out. So that conversation needs to happen between you and the CS.
Okay, Chirag. Thank you.
Yeah, hi Chirag. I have one question.
Hey, Zila.
Yeah. So actually, these days, so can finding a VC be outsourced? Maybe a little bit a strange question, because this takes a lot of resources, lot of time. We are a small team, and I don't see that where to dedicate time. And another aspect is that these days we get a lot of calls, lot of some sources that they can arrange funding for us, being on commission basis. So does some VC work in this mode, or VCs like to work directly on me?
So let me first talk about can this be done and what is the implication of doing that. Yes, it can be outsourced, and there are many bankers and many individuals, many organizations offering the service to help you fundraise. And some of them are probably good. I don't know them personally. Having said that, I personally, I'm not very open to these individuals, because more often than not, they will sell anything to anything. For industry-specific VCs and the deep tech VCs, generally, they have their sources defined. Like for us, we'll go to IIT Chennai, IIT Bombay, IIT Delhi, and a few other incubation centers or accelerator programs, and that's it. Anything beyond that, we will look at with a lot of suspicion that if some random guy has reached out to us to kind of sell an opportunity, we look at it with a lot of suspicion that maybe it was not very good. That's why they had to hire someone to do that. But that's just us. In the early stage, I know that suspicion level is higher to have someone else do it for you. But at the later stage, when I say later stage, I mean Series B and beyond, it's very normal to have a banker help you.
So bankers and generally individuals, you are saying, how much they charge?
So they charge anything from 2% to 10%.
Hi. So I have one more question. I have a doubt.
Yeah.
So you have at the start of the meeting, have said that VCs expect around 10 to 20 times return. Right. So what if the 20 times returns?
Yeah.
Investment returns. Yeah. So is this based on valuation or the revenue?
It's everything is based on valuation, because for us as an investor, and this may not be the right thing, which I agree with, but valuation is everything.
Yeah. So I have a follow-up question on that.
Yes, Ajay.
So what if the company doesn't want to raise more than 1 or 2 investments, like investment rounds, and they want to expand or increase their revenue? So
Which is great. We should increase the revenue, but Vijay, let me ask you this question. If I give you $1 million and you scale amazingly well because of that, and then you become a sustainable business, which is good, which you should become a sustainable business, profitable, sustainable business. The question that I have to answer to my investors is, how do I get my money back? So now how I can get the money back, either you do an IPO where you give me my money back, or I sell my equity to someone else in the secondary market, or you raise a subsequent round where I get an exit. So there has to be some way I get my money back, because if your business runs for another 50 years, most VCs are not in the business of waiting for 50 years. Most VCs are in the business of waiting 5 to 7 years.
Yeah, thanks.
But thank you, Vijay. Thank you, everyone. It was a great conversation, great interaction. My contact details are available to you. I'm always available on LinkedIn. And I would love to have conversation one-on-one if needed. And happy to have a conversation. Thank you, everyone, for your time.